Hey guys, welcome to Investing with JYK, and today we'll talk about a very obscure company. It's called MIND. It has nothing to do with Mind. It is actually a billing software provider. This is a, a company that's based out of Israel, has a market cap of like 50 or something million. Yeah, $40 million. So the same problem exists with this one as some of the other pico caps that I talked about. This is going to be liquidity issues. And they provide two. They provide two software. One is called Mind, or maybe it's called Mind, but it's the billing thing. It's a billing software for telcos. And then the other one is called Phone X. Actually, it's called Phone X1, which is a very weird name, but what it does is they sell to large corporations to keep track of telecommunication expenses. It sounds all very boring, and indeed that is true. And that's actually why I like it. So, let's first look at this thing. You can see that they have billing, and then I don't actually know what this UC analytics is, but in their annual report, you will see that they just break out two segments, basically. Now, so the two segments, you can see that is product line A, which is the billing solution, and then the product line B, which is the phone call accounting, so telecommunication accounting software. Sounds extremely weird, like why would anyone buy that? But apparently there's a need because they sell quite a bit. And in terms of the percentage, most of their revenue comes from product line A, which is their old product. I think they acquired someone in 2000 and something, 2010 or something, that actually had product line B, which is the telecommunication accounting software. And the other one that is interesting is that most of their revenue comes from US, so that means most of their revenue is in dollars. A little bit of that comes from Europe and UK, and you can see that has been declining, going from like 6.5 million down to something like 3.2 million. And the Israeli revenue is declining as well, and other revenue is declining as well. The US revenue is the only one that's increasing. And overall, their total revenue is not growing, and that's true even for long periods of time. And let's see. Yeah, the stuff they have, you can see, is mostly in Israel and Romania. And it appears that most of their software is developed in Romania. And their CEO, I think, is Romanian. So they have like very strong ties with Romania. So presumably cost is much lower in Romania. So as long as they can manage their R&D well in Romania, it can prove to be a strength. And the other stuff, they don't really have much cost other than R&D and some professional services stuff. So that's basically there. And then, yeah, so, okay, so let's look at their balance sheet, which is one thing that I like quite a bit. I'm looking for F1. There you go. Balance sheet. Bunch of cash/cash equivalents, some receivables, very little receivables in fact, $1 million total, and that's actually quite good, because if you think about it, these are B2B companies, and then the payment terms are usually not that good, because their revenue total is something like 20 million or something per year, and they only have $1 million in receivables, so that's actually pretty good. And then you can see that most of their asset is in cash. They have some property and equipment, which is tiny, and then the goodwill, I think that came from the acquisition of this PhoneX stuff. And yeah, that's basically it in terms of their assets. Now, coming to the liability side, which is what I like the most, they have no debt. They have no interest-bearing debt. They have some employee rights, which is like $1 million, which is tiny. And they have some deferred revenue. That's basically revenue is recognized, but the services are yet to be provided to their clients. So yeah, that's that. And it's very, very clean balance sheet, very simple business. They have two software, they sell it, and they charge some money, and they go home. So now let's look at the income statement. They have licenses and services, and you can see that license sales is quite low compared to the total revenue. Total revenue is 18 million, not 20, but it's ballpark there. And in terms of gross margin, you can see license is essentially all margin, more than 90%. If you look at that, about 90% is margin. But when it comes to services, obviously it's lower. It's about something like 50 to 60% gross margin. So overall, the gross margin is fairly high at about, overall, what you're looking at more than 50%, something like 60 to 70% gross margin. 60 to 70% is not fantastic for a software company, but this really isn't much of a software company. There's another couple of things that you can see. Like R&D, while fairly high compared to their revenue of 18 million, so it costs about 1/6, 1/7, so 1/5 to 1/6 of their revenue, so quite a high percentage, but in absolute terms, $3 million of R&D budget is laughable, right? And then most of their other cost comes from selling, so sales cost and some SG&A. But it's true that most of their, outside cost of sales, most of their cost is from R&D. But that if you compare this thing against cost of services, you can see that cost of services is still like double your R&D. And yeah, and very simple thing, no interest. They make, something like 20 to 30 cents a year, and they've been making that for quite a while as well. And yeah, okay, so without even going to the cash flow statement, from this alone, you can probably guess that really there isn't going to be much room for manipulation in terms of accounting, because they have very little depreciation. The reason is that they have very little PP&E. like for 200K, right? As a percentage of their revenue, this is 1%. So you can't hide anything there. The receivables is tiny compared to their revenue, so you can't hide anything there. Most of their asset is in cash. So overall, this is a company that really cannot do much accounting manipulation. There's one place there where they kind of can, because they have projects. They have like implementation projects for different clients. When you have a new client coming online, they have to estimate the percentage of completion for these projects, so they account revenue that way. But the thing is, you can see that they have these deferred revenue, which is quite a large percentage. So basically means they are actually getting paid upfront. That's why they have to account for the deferred revenue, because that's the non-completed parts of it. So for this business itself, yeah, the EPS is subject to some kind of manipulation, but the scale is going to be very small, and the earning is going to be very high quality because it's all cash. Very little investment needed, and no capitalized R&D or anything like that. Let's see, cash flow. Okay, so cash flow. Right, so cash flow is here, and yeah, this is what they have. They're really quite simple. Major things, sometimes they sell, like they sell a subsidiary or something, but so that has to be taken out of the operation cash flow. And they have some increases in receivables, but really it's quite small. And yeah, then you have the deferred revenue increase / decrease, right? So basically this is burning down the backlog. You can consider deferred revenue as backlog. So while it is true that their backlog for the last year was reducing, this is a small company, so it doesn't, like, the earnings is not going to be smooth. And then we can look back in their history. You will find out that they, even in the depths of 2009, they were doing somewhat okay. Okay, right, and yeah, so free cash flow is always going to be pretty good. Most of their cash is, well, in terms of investment, when they do invest, it's basically buying bank deposits, which is kind of weird. In US, that would account, you would put that in cash, but in here, as well as some other countries like China, this is an investing cash flow. It's kind of weird. So you can ignore this, line, and this one they actually sold. So you can, this is like, this is non-recurring. These two lines are basically net zero long term. And yeah. And what do they use their cash for? Well, they just pay out in dividends. That's all they do. And you can see this is quite good. They pay most, if not most of their free cash flow out in dividends. So yeah, and it's quite a clean business. And now we have looked at its balance sheet and the reports. I think it's a good time to stop and think about the nature of this business. As I have alluded to before, it's not really that much of a software company, but more of like a service provider. And what they sell to is, clearly they're not selling to T-Mobile or Verizon, because the revenue is only 20 million, and an accounting software for Verizon, T-Mobile presumably is going to be tens of millions alone, or if not hundreds of millions of dollars per year. So these would be taken up by probably Oracle. So they have to sell to the second tier telcos, and that's exactly what they sell to. They actually mention it. Telecommunication. All right, you can see that 82%, and then they have like a tier 2. We provide tier 2 and tier 3 service providers with what about blah 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 blah. Okay, so that's for their accounting software, right? And then for the phone 1X thing, they sell to big companies, but that's only a small percentage of their revenues, like 1/6 of their revenue. So majority is going to be coming from these telco providers. Now these are like the regional telco providers, not the national one, not AT&T, not Verizon, not T-Mobile. In US, because remember most of their revenue come from US, and the one risk that I see with this company is the continued consolidation of telco businesses. So as small companies get bought up by big ones, right? If you are, let's say, Metro PCS, for example, used to be a small player in US that was bought by T-Mobile. Now, once they were bought, if they used to use MIND for their accounting, for their billing, once they're bought, they will be using T-Mobile's billing solution. Right? So that's a given. So that market, the total addressable market itself, could be shrinking. It is a possibility. How do they counter that? They could provide like an upsell. They could upsell more stuff to the existing ones, or they could dig up more places to sell to other than US, maybe to the Caribbeans or South America or something like that. But that would involve a whole lot of other kind of risk, like currency conversion, all that stuff. So that is the biggest risk I see with this company, is that the shrinkage of the total addressable market. Now, if you look at their financials for the past 10 years, let's see, and then if you look at the income, that actually hasn't come home to roost. If you look at the revenue's gone from 13 million down a bit in 2009, which is when everything went to shit, and they had a huge bump in 2014. That was I think that was when they either did the merger, when they bought something, or they had a few big contracts. It's not smooth at all. But now it's like 15 million. So accounting for the inflation, basically they probably hasn't increased anything. So this is not a growth company, and don't expect them to grow at all. Yeah, so total revenue used to be 19, has some other revenue, and then now is 18. So no growth here. Gross profit hasn't increased either. So it could be a pure cigar butt that is just going down and down. It's not in Buffett's terminology, not a compounder. This is anything but a compounder. And they're doing the right thing for something that's not a compounder. They're paying every single cent out, really. This business really just exists to pay out dividends. It's like just a cash flow company. But one good thing is that SG&A, sales and marketing, actually went down quite a bit, from 3 to 1.25. And G&A, the same thing, right? G&A went from 2.4 to 1.6. R&D went from 6 to 3. Everything's shrinking, but they continue to be able to churn out profit and cash flow. Right? Operating expenses total went from 16 to 3. So even though their total revenue declined a little bit, their operating expenses went down a lot more in comparison. And then, which means once you look at the operating profit, it went from negative number to positive, fairly positive. And if you look at, just look at, I want the cash flow. Damn it, my screen is lagging. Right, so if you look at the cash flow, and I just want to look at, okay, from operating activities. I mean, last year there was a little bit of change in terms of the runoff of some of the contracts, but cash flow itself was basically steady for this entire time. So from 2008, if we go to 2017, so cash flow was something like, so this is, yeah, I remember them now. This is when they got some big contracts and it kind of ran off. So it fluctuates between $3 and $4 million. And from investing activities, it's all over the place. They sometimes buys a subsidiary. But if you look at the stuff, this is when they bought a subsidiary, I think. I think this is when they bought the subsidiary. But even if you look at this, it's the same scale as their operating cash flow. So they never needed to raise any kind of debt. And if you look at from financing, they don't raise debt, and you can see they pay more and more dividends. That's 2012. That is. I think they only started paying in 2000. They started paying in 2006. So even 2008, yeah. So you can see they paid a huge dividend in 2009. I think that's I don't remember what happened there, but if you look at this graph, it was like a special dividend that they paid, 2009. Ignore these quarterly numbers, this is wrong. They paid 80 cents instead of 20 cents. Now they pay like 30 cents. Maybe they'll pay more, maybe they'll pay less next year, we don't know. So yeah, so they keep paying dividends. So this is not a scammy company. And then the last thing I want to consider is the share structure. So a lot of this will tell you this is a company built to benefit the shareholders. And it's not a company built for its CEO as an empire building tool. The reason is this company is owned by a woman called Monica Youngku. Is the founder and the CEO. She's like 60 years old. Yeah, she's 60 years old and probably don't have much ambitions anymore. Now, if you look at here, salary, this is for people not in this industry in terms of tech. This is a salary of a decent software engineer. And if you the total package of a senior staff engineer, so pretty high on the stack, maybe 10 years experience or 15 years experience, something like that, $350K per year, US dollars. Right, so this is she's getting in terms of salary, but with the bonus, she gets paid a bit more, so $500,000 to Miss Youngku. and their CFO is paid like an entry-level software engineer. Their VP of sales got paid a lot. I mean, salespeople mostly is on commission. You can see that, which makes sense because salespeople, most of them just work on commission. And this guy is not that much, and then this VP of IT is not that much either. These are not high salaries. And then you look at why that is, because this woman, Miss Young-Koo, has a lot of shares. Yes, Young-Koo has 3 million shares, or 17% of the company. And I mean, she's pretty old now, so she started selling the shares in 2012. There's an automatic sale of the shares, and she's sold up to now like 500,000 shares in 6 years. So this selling would probably continue until she's like 80s or something. Let's just calculate how much cash she receives out of her stock holdings. So she receives $663,000 in dividends a year, and her salary, including the bonus, is $500,000. Right? Now you can see that for her, if the stock price goes up, even by 20 cents, she would have made in that year more money than her salary. And if the stock goes up $1, then holy shit, the world has exploded. She has made 6 times her annual salary. Yeah, so she's very invested in every sense of the word in this company, and this company, yeah. So that, I think that's where the whole theme ties together. It's just a company that is really built for the benefit of the owner, and the owner doesn't really have that much ambition. So as stock shareholders, us, we get treated almost like her, except not as good because we don't get paid any salary, but $500,000 in salary isn't that ridiculous, if you ask me. And okay, so then the next thing is, let's think about their share stock price. So this thing went public in 2000. It's top of the .com bubble. So if you bought there, good luck, you're fucked. And it went down to like less than $1 after the bust. But this company is actually one with actual business. So they started selling, and they immediately started producing dividends. Wow. Okay, so they've been paying, if you look at it, the first time it was 14 cents. Then it's about 20 cents all the way, except 2019, don't know what the heck went on. Maybe she just wanted to buy a lot more shares. Maybe yeah, that would be interesting to see. I'll check 2010's report and see what the I'll put the results in the notes. See if Miss Yang-Koo actually bought more shares. But yeah, since then it's about 20 cents to 30 cents of dividends every year. Goes up and down depending on the year. And if you see the down years, 2009, 2008, they still paid dividend 20 cents. And back then, if you look at it, it was 60 cents. Right? So if you had the balls of buying it there at 60 cents, you would have gotten an 80-cent dividend immediately. at the end of the year. Holy fuck. Yeah, and then the same company, same kind of business, if you only bought it here, you would have been royally screwed. So yeah, no business, no asset is too cheap. Sorry, no asset is so good that there's an expensive there. It can't be too expensive, right? So and no asset is so bad that it can't be too cheap. So all right. So conclusion. Well, I haven't bought yet. I want to buy. I want to get it at $2, hopefully. Maybe it will drop more. Maybe drop quite a bit more. Maybe it will drop to like $1 again, just like 2008. Or maybe it won't. Who knows? But so long as this one keeps printing out free cash flow, yeah, I think it's a keeper. And actually, let's not wait until I check the 2008. It would be nice if we can just find the 2008 numbers. Oh my god. This is the shittiest investor relation. Come on. Annual reports. Up to 2017, you serious? I want a 20F for people that don't know. 20F is the annual report for foreigners. Let's look at 2008 when things were super shitty. I bet it was a net at the bottom of the cycle. But let's see. Balance sheets. All right, here we go. So 2007, what date? December. Okay, so yeah. My God. Holy crap. Hold on. Let me just find the actual balance sheet. Statement of balance sheet. Oh, come on. Damn you. Is there like a content, table of content? All right, we need F3. Here we go, F3. 2007. 12 million in cash. Liabilities, nothing here. Current liabilities, nothing. Okay, so in 2007, it has $12 million and no liabilities, basically. And the market cap back then was probably something like, because the stock never split, so the market cap would be was something like 60 cents, 1/4, 1/3, let's say 1/3, so 13 million, yeah. 1/3, if it's 1/3 is about $13 million, and then they have where are you? They have $12 million in cash. And let's look at 2008. Let me go to F2. Where's my F2? Oh. What? Okay, consolidated balance sheets. All right, there we go. This is dumb as F. Let me just find it. Wait, what? That is weird. A 20F without... Oh, you have the exhibits. By reference to our 6K. All right. March 9th. All right. Let's search for 6K then. On 2010. Search. Oh. 2009, 03, 04, 01. March 9th. This is the one. And we have exhibit. I forgot which one, which exhibit it was. Exhibit 2. Oh yeah, here you go. Consolidated financial statements. Yay! Okay, in 2008, they had $9 million in cash, some receivables, and no debt. So here we have, and then if you look at cash flow, let's see. La 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 la. Oh yeah, their revenue even increased. Yeah, so they have an increasing revenue, then stock price dropped by 2/3. Oh, they do have a loss. What loss? How do they make the loss? Impairment of goodwill. Okay. So they impaired their goodwill. So that's where the loss came from. And what else they have? Impairment of auction-rated securities. Okay, so another impairment. So they had two impairments. Not their own business, by the way, just two impairments. And the stock dropped by massive amounts. Massive amounts. Yeah, so the gist is buy this thing when it's 62 cents. Total number of and when it has a bunch of cash, 62 cents positive cash flow. Actually, let's look at the cash flow back here, 2000 and where's my cash? Okay, what did I say about positive cash flow? Bull. Yep. And if you like this one, click like and subscribe. If you don't like this one, click dislike. And I will see you next time.